Intel just gained 8.8% in a single session, a company that Wall Street had largely written off as a cautionary tale about missing the AI wave. Before you assume the turnaround is real or dismiss it as noise, consider this. The last time INTC moved this hard on this kind of volume, it preceded a 34% reversal over the following 6 weeks. So the question isn't whether today's move happened. You can see it on any chart. The question is what's actually driving it, who's buying, and whether the fundamentals have changed enough to justify a new narrative. Let's start with the facts. Intel's 8.8% move in June 2026 did not happen in a vacuum, and it was not driven by retail enthusiasm alone. The primary catalyst was a combination of events that, taken individually, would have moved the stock modestly, but hitting simultaneously created a compression release on a heavily shorted name. First, Intel announced progress on its 18A process node, its most advanced manufacturing technology, confirming that a major hyperscaler, widely reported to be a US-based cloud provider, had signed an expanded foundry agreement. This is significant because Intel's foundry ambitions have been the single most contested thesis on the stock for 2 years. Skeptics argued that TSMC's manufacturing lead was insurmountable. This agreement doesn't disprove that, but it does signal that at least one major customer is willing to bet real money on Intel's roadmap. Second, and this is the part most coverage buried in paragraph 7, Intel's short interest heading into today was sitting near 6.2% of float. That's not extreme by meme stock standards, but for a large-cap industrial semiconductor company, it's elevated. When a heavily shorted stock gets genuine positive news, short sellers don't wait around. They cover, and that covering adds mechanical buying pressure on top of genuine demand. The result is an amplified move that can look more decisive than the underlying news warrants. Actionable insight here. Before chasing any gap up, pull the short interest data. If a meaningful percentage of the float is short, you are not just evaluating the news. You are evaluating a short squeeze overlay on top of that news. Those are two different return drivers, and they have very different half-lives. Here is where we have to be honest, because this is not financial advice, but it is an honest read of the numbers. Prior to today's move, Intel was trading at roughly 22 times forward earnings, a multiple that already embedded a recovery scenario that Intel's execution history did not fully support. After an 8.8% single-day gain, that multiple expands further, which means you are now paying more for a thesis that is still largely unproven in production at scale. Compare that to where AMD and NVIDIA trade. AMD sits at approximately 28 times forward earnings with a cleaner data center growth trajectory. NVIDIA is in a different stratosphere, but its multiple reflects demonstrated dominance in AI training infrastructure. Intel, even after today's move, is priced as a turnaround story, which is fair. But turnaround stories have a specific risk profile. The upside is real if execution holds, and the downside is severe if it doesn't. The 18A node is the crux of everything. Intel's previous advanced node, Intel 7, came in reasonably on schedule. Intel 4 had delays. The market's credibility meter on Intel manufacturing is cautious, not broken, but it is not repaired either. One foundry customer agreement is a signal, not a verdict. What does institutional behavior tell us? Volume on today's session ran approximately 2.4 times the 30-day average. That is not panic buying from retail. That is block trading from funds repositioning. When volume is that elevated on a positive catalyst, it often indicates that institutional players were underweight and are now normalizing position size, not necessarily making a high-conviction bet on multi-year outperformance. The move is partially justified. The short squeeze component inflated it. The sustainable portion of the gain is probably in the 4 to 5% range. The rest is mechanical. That distinction matters enormously if you are thinking about entry timing. This is the section that will save some of you real money, so stay with it. When a stock moves 9% in a day, the psychological pull to buy is almost irresistible. The reasoning goes, smart money is clearly buying. The news is good. I'm missing the move. That logic is understandable and almost always wrong in its timing. Here's what the data actually shows about large-cap stocks that gap up 8 to 10% on above-average volume. In a study of S&P 500 components from 2010 through 2024, stocks that gapped up between 7 and 12% on volume, more than double their 30-day average, showed a clear pattern. In the subsequent 5 trading sessions, approximately 61% of them gave back between 30 and 50% of the gap. Not all of it, but a significant portion. The stocks that held their gains and continued higher shared one distinguishing factor. The catalyst represented a durable, recurring revenue change, not a one-time announcement or a beat and raise that was already partially priced in. For Intel specifically, the foundry agreement is recurring if it converts to production volume. That is the conditional clause doing all the work. The question for a rational buyer right now is not whether Intel is a good company. The question is whether today is a good entry price. And the honest answer is probably not the optimal one. If you believe in the Intel foundry thesis, and there are legitimate reasons to, the better framework is to wait for the first consolidation after a move like this. Stocks rarely go straight up after a gap. A pullback to the prior resistance level, now theoretically support, offers a cleaner entry with defined risk. You might miss the next 3%. You protect yourself against the common 15 to 20% reversal that follows premature entries on gap-up days. Patience is not passivity. In this market, patience is the edge that most retail participants voluntarily throw away. So here's where we land. Intel moved 8.8% today for real reasons: a foundry deal, short covering, and a sentiment shift that was overdue. But the magnitude of the move overstates the fundamental progress, and the optimal entry for believers in this thesis is almost certainly not today. The open question we did not fully answer: if Intel's 18A node hits volume production targets by Q4 2026, what does the fair value actually look like? That analysis is coming next. Subscribe so you do not miss it.